Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Friday night, 10 o'clock. That's right. First time I've done that from the office this time. One of my college buddies who works with us here at PRMG, he's 47 this week. I left the office at 3 o'clock, took him to play golf. We had a beer or two on the course and then went to dinner. May have had some more cocktails. This is a different Friday Funny version, so bear with me. This is a first for me. I owe you. I owe you 2 videos a week, and I was at the Lenders One conference in Arizona. I'm going to the ICE Mortgage Experience in Vegas. I leave there Sunday. I'm there till Thursday. And the week after that, I'm at the Mortgage Collaborative in Miami. So I may not have memorized everything I want to talk about today. I may read off some stuff to you. And my videos on Thursday get almost no engagement. So we're trying something new. So I hope you like this. I played in the Hogue Classic. Hogue is a hospital system in California. My last 2 children, my son, my 3rd kid, my son, and my 4th child, my 3rd daughter, were both born there when I moved to Newport Beach. And they are a title sponsor for a Champions Tour golf event. And we have a warehouse line with City National Bank, and they are awesome. I also personally bank with them. They invited me to play in a Pro-Am last week. I played with Freddie Couples. Thank you, Aaron Cohen. Thank you, Mr. McCrae. And thank you, City National Bank, for inviting me. Yes, I'm totally repping this. All right, here we go. We are at a 3.8% unemployment rate. 12 of our 50 states in December have had the lowest unemployment rate ever. We have over 11 million job openings. The economy is strong. Of course, with the Russian invasion of the Ukraine, well, there's a heightened sense of inflation. There's a sense of unexpected inflation, maybe worse than we think. Nickel, for example, Russia is a huge producer of nickel. If you could, by law, melt down nickels, the nickel is worth 12.5 cents. So $100,000 per metric ton was the going rate for nickel for the London Mercantile Exchange, which is owned by a Hong Kong company which stopped the trading the other day because there were Chinese companies that were short nickel. So it's kind of like the whole GameStop thing, right? Very interesting to see what's going on in the market, how commodities will play out, how fertilizer, how wheat, how oil, how crude, and all the other things that come out of both Russia and Ukraine. We'll see how they filter their way into our economy. You know, I heard that there's $800 billion of sovereign debt for Russian debt, sovereign-owned pension funds for Russian debt. What if they just defaulted to zero? What would the ripple effect be? To offset the loss of Russian trade, Russian equivalent of treasuries, Russian ruble losses, Russian whatever losses, you got to sell the good stuff like Apple and Amazon, which had a 20-to-1 split, and a $10 billion announced buyback. If you have to barbell approach as an institutional investor, I lost in Russia, I got to sell the good shit over here in America. What does that do to our 401ks? What is the ripple effect if all this stuff starts selling? Remember the Viacom CBS scandal last year that we talked about? The guy got over leveraged. He went to UBS, Deutsche Bank, Morgan Stanley, Goldman Sachs, had 10 billion, 100 billion out with each one of them, leveraged, bought a bunch of CBS stock, and then it all came down when the margin calls happened, and everyone had to sell off to offset their impending losses. That ripple effect hurt everybody. It crushed that stock. Could the ripple effect of Russia, which is the 11th largest GDP nation in the world, a G20 nation, the ripple effect is that large and there's a contagion. Could it affect us? Could it affect you? Could it affect your 401k? Could it be the straw that breaks the camel's back, put us into a recession? I don't know. Anyway, it's something worth talking about. So we're talking about a couple of things. So Biden said it's time for Americans to get back to work and fill our great downtowns again. I think what he's saying in a unique way is the pandemic is over. I haven't heard anyone say it. I haven't heard anyone come out and say the pandemic is over. But I've seen a lot of smiling faces. My chiropractor that I went to yesterday because my neck and back hurt, I saw his face. I go, what did you do? Did you change your hair? Are you not wearing glasses? He goes, I'm not wearing a mask. The pandemic is over. Yes, some people will still get sick and there will be deaths, but the pandemic by and large is over. 2 years ago, this very moment, 2 weeks to top the spread, right? 2 weeks to stop the spread. 2 years later, can someone please say it's over? It's over. The pandemic is over. Twitter's going back to work. Google's going back to work. Why can't someone come out and just say it's over? Anyway, unexpected inflation is the problem. I talk a lot about uncertainty and unknown unknowns. We need to talk about unexpected inflation. Maybe rent's worse. Maybe food costs are worse than we think it is. Maybe oil is going to go up forever. We just saw an inflation read yesterday with the consumer price index, 7.9%. Holy smokes. That's unbelievable. However, there's $2.4 trillion sitting on the sidelines in people's accounts. $2.4 trillion. That's a lot of money to offset the effects of inflation. Now, do we have the haves with that $2.4 trillion and the have-nots who don't have much, who can't afford higher rent, higher food, higher oil, higher gas? Will that group say, you know what, I'm not going to drive, I'm not going to travel, I'm going to eat other stuff? I read that the Obama administration is saying just pour more water into your ramen so you can feel more full. If that's the case, and people offset inflation by destroying demand, what will that do for the growth of our economy? Will GDP go down? Will we go into a recession? Or will those who have more money continue to spend and offset those who don't? I don't know. I don't know the answer to these questions. Bank of America has $19 trillion of cash. Goldman Sachs said there will be $1 trillion of buybacks in the stock market. So if you're worried about your stocks, which we all are, perhaps the company that you believe in, like Amazon this week, will say, you know what? $2,780 on the 200 moving day average for our stock is too low. We know our company rocks. We're going to buy 10 billion and we're going to do a 20-to-1 split. I'm not a stock advisor. I am not responsible for your losses, only your profits. Go to someone who knows what they're doing if you want real stock advice. And the 20th hijacker, a gentleman from Saudi Arabia who we are now talking about doing deals with for oil because we're not buying oil from Russia. We're banning oil from Russia and everything else. The 20th hijacker of 9/11 is going to be released from Guantanamo Bay. Did you know that? I don't know what you listen to, but I read everything. The 20th hijacker responsible for 3,000 deaths is being released from Guantanamo Bay. I don't know if you knew that or not. I just thought I'd mention that to you. Friday night, we're having fun. It's good stuff. Gonna be on the road again. Maybe I'll do some more Friday funnies from my desk again if my wife will allow me. Have a great weekend. Cheers.
Hey, it's KP coming to you live from Las Vegas, Nevada. Here we are at the ICE experience. ICE is Intercontinental Exchange. They are the owners of Ellie Mae. They bought Ellie Mae. That is Encompass LOS. Very good event here for those that are in the business. It's pretty lively, good traffic. great speakers. ICE had an executive summit where they had Karl Rove and Paul Begala speak about housing policy and where they think things are going. Former U.S. Senator Kelly Loeffler was the moderator. Her husband, Jeff Sprecher, who's the chairman of the New York Stock Exchange, which is owned by ICE, was also here and participating in the event. They had Derek Carr, the quarterback of Las Vegas Raiders, and Matt Ryan, the Atlanta Falcons quarterback. They were on a panel, talking about leadership. We got a chance to see Super World. Harish is the owner of that. Check it out. They're trying to lay a digital world on top of the real world, some metaverse type stuff. And then we had some great influencers. Jade and Brett Evans from Expedition Evans. They were sailing around the world and kind of documenting it. And then also Rose, Finances by Rose. So really awesome panels, great content. It's just a fantastic event. There's a lot of people here. It's some of the booths have gotten bigger over the years than they were in the past. And there's the Recora folks. Sitting there walking around, cutting a video. So this could be a little distracting. Maybe my audio sucks, but I'll try and get outside for you. What's going on in the real world? Well, the Fed speaks tomorrow. The Fed is going to be talking about whether they're going to raise their interest rates or not. With the Ukrainian invasion by Russia, we're probably looking at only a 25 basis point hike, which is what was communicated by Fed Chairman Powell. Will the comments be dovish? Will they have 8 rate hikes this year? I mean, we already see the 10-year Treasury at 2.15. That's a really high level. We have not seen it over 2 and sustained over 2 at that level yet since pre-pandemic, basically. So, we've got a lot of stuff to worry about. We're worried about the Fed's policy. We're worried about inflation. Say goodbye. There we go. Getting outside. It's a little bit calmer out here. Hopefully my audio is a little better. The Fed inflation, they have a lot of different reads, right? The consumer price index came out last week. It was 7.9%. The producer price index came out yesterday. That's what producer input costs are. The consensus was to be up, I believe, 0.9%. It was up 0.6%. So that's seen as a win. But still 10% producer price index year over year, 10%. So then you've got what they call core PPI, which is where you exclude food and energy. Although I don't know a human in our country that excludes food and energy. You got to eat. I think it's the third need in Maslow's hierarchy of needs, not Laszlo from Real Genius. But yeah, the consensus for core PPI was supposed to be up. Thank you. Up 0.6%. It was only up 0.2%. Still super high. Over 8% read on producer price index. Here we are, beautiful Las Vegas. Some more scenery. Gotta love that. But yeah, the Fed's actions are super important tomorrow. I hate to use hyperbole and try and hype it up, but that meeting is going to help shape, where things are going for the rest of the year. Are we in a recession? People are talking about a recession. We know that earnings will slow down. We know that inflation is going to hurt companies. It's certainly hurting our pocketbooks. And when our pocketbooks are hurt and we spend less, the GDP is 70% of the economy's, 70% of the economy's GDP is consumer spending. So we're going to see how that stuff all shakes out. We got great people from the Mortgage Bankers Association here. We've got ICE here. We've got all kinds of booths. Everyone's waiting with bated breath. What's going to happen with the Fed and their policy, inflation? What are rates going to do? Are they generally going to go higher? Is this as high as they're going to go? I don't know the answers, but I know that the details and the data that the Fed had is more than pretty much anybody I know. And we're going to see what that stuff looks like tomorrow. So keep an eye on that. The question and answer session at the end of the Fed's policy read is usually pretty telling and revealing. So, definitely keep an eye on that. And I'll have another video cut hopefully later this week. Traveling quite a bit. We got Mortgage Collaborative next week. Vegas is not too hot right now, a little overcast. It's all good. By the way, last Friday, quantitative easing ended. The tapering was over. Last Friday was the last day the Fed bought treasuries and mortgage-backed securities. It's a big deal. They've been reducing their fiscal stimulus. Now it's gone. Now it's time to talk about raising Fed fund interest rates, which is what banks lend to each other. So odds are pretty high. That'll be a 25 basis point hike. It's the language that they use, talking about, will they be measured? Are there more headwinds? Our employment is strong. We have over 11 million job openings right now. We're certainly over 10, 3.8% unemployment. Still not quite to full employment where we were pre-pandemic, but very, very strong. So a lot of factors come into play. We'll bring some more certainty. I know I wanted to say the pandemic is over. I saw a CNBC clip this morning where Dr. Scott Gottlieb is saying that in the U.S. we have herd immunity. So he's using the words herd immunity. They're actually saying it. But you have a spike in China going on right now, and they're having lockdowns in Shenzhen, which is a huge manufacturing city, a massive manufacturing city. That could hurt supply chain issues. That could hurt inflation. So could oil, so could wheat, so could fertilizer, so could everything coming out of Ukraine. Having said all that, just got to keep pressing forward, be positive. Have a great week. Cheers. Hey, it's KP coming to you live from Culver City. My neighbor here is jamming out. Can you hear that? Buddy of mine from the University of Texas at Austin is an architect and owns a bunch of real estate, designer. And today was demolition day. And funny enough, on this spec home that we're building, financed by RCN Capital, thank you, Jeff Tesh, CEO, Chris Doran, amazing originator. And of course, the appraisal was done through Mike Tedesco, Kevin Petaway, Jason, and the whole team at Appraisal Nation. Interestingly enough, today was housing start data. And housing starts is data that is taken up, and it's, when a new project starts. And so we just got our permits on this spec home from the city, Culver City. And this bad boy right here, I wish I could have got some live action, but unfortunately I was still flying in from ICE experience in Las Vegas. Pretty cool though, right? So it is St. Patrick's Day. Happy St. Patrick's Day for all you out there. There's still some original structure left, although we may get the sledgehammer out here pretty soon. Anyway, housing starts are up 7%, 1.77 million housing starts. We have a major supply issue when it comes to housing supply. Every neighborhood is different. Every area is different. People ask, is there a bubble? There isn't a supply bubble. We don't have enough homes for the demand that's out here. And the demand for first-time home buyers is pretty robust. So household formation happens at age 33 on average. So if you bought a home before age 33, you can claim you're better than average. That is the average age of the first-time home buyer. And what I will say is that as we continue to get through this housing supply shortage, which is exacerbated by supply chain issues, inflation for costs of lumber, which is going back up again, finding good workers. We have, 10 to 11 million job openings, tons in construction. It's hard to find good help right now. That's why houses are expensive. This isn't exactly a starter home, but it is an up-and-coming neighborhood. For those who don't know where Culver City is, we're just a little bit inland from Playa Vista, Marina del Rey, and it's got a cool vibe. I mean, obviously the neighbor's playing guitar. Like, how cool is that? And my buddy and partner, he and his wife, they've already built a home and sold it successfully here in the neighborhood. So absorption is still good. Housing is still strong. Things are still robust. All the doom and gloom that you saw out there, about the R word and the recession and slowing growth, there might be that. But if you have to buy a house, you're going to buy a house, and there aren't enough of them. You look at the housing supply each of the last couple decades, and there's usually about 10 million houses, built per decade, I believe. Maybe I got that stat wrong, but I know we're way undersupplied in the last decade after the housing crash. The bubble was both a supply and a credit bubble. We don't have a credit bubble right now. Loans are extremely difficult to get compared to how it was prior to 2008, prior to Dodd-Frank. And let's talk about Dodd-Frank working. Qualified mortgage versus non-qualified mortgages. Non-qualified mortgages are all paid for by the private markets. Fannie, Freddie, and Ginnie do not do non-QM loans. A loan one day out of bankruptcy. A loan 6 years.
and 364 days out of bankruptcy or foreclosure. They wait 7 years. So we don't have a credit bubble. And that's important for the health of our economy. The job market is strong. Companies are still strong. So sometimes people look at what's going on in the stock market and they extrapolate and go, there's a problem. We've got inflation and there's too much money sloshing around the system. But credit is what builds our economies. It's not just money. If you ever check out Ray Dalio and his principles on lending and banking, he's got a great video where he talks about money versus credit. There's only $3 trillion of money in the market, but there's $50 trillion of credit in the market. Loans to build this stuff right here for people who have the ability to pay, which is literally legal verbiage in Dodd-Frank. That ability to repay and pay those loans is what continues to have the velocity of money and build our economy. And so housing starts were strong today. The economy is strong right now. The Fed came out and brought certainty to the markets yesterday. Big deal. And they said, we are going to do up to six interest rate hikes this year, 6 more, in addition to the one they just did yesterday at a 1/4 point. That brought certainty to the markets. Remember, just not even a week ago, there's going to be 8, there's going to be 9, there's going to be 4, there's going to be 6, there's going to be 50 basis points. It's 25 per. And there's going to be 6 more after the one we just did. We'll basically have a 1.9% Fed funds rate. And that's if we even take it all the way through to the end. The only uncertainty that was left in that statement was that they are going to ease their balance sheet and, let it run off. And what does that mean? How quickly will they sell it? Will they sell it quicker than we thought? Because, that credit, that liquidity, that credit supply to the economy that the Fed hit to get us and reflate our economy, now they're going to pull some of that back. So will that decrease credit? Of course. In that decrease of credit and money supply and velocity of money, will it slow down our economy? Yes, it will. But will it slow it down enough for us to go into a recession? I don't know. Traditionally, that is the case. But we are going to be in recession eventually at some point, and it's going to happen after the Fed makes these actions. So, it's part of a cycle. We have debt cycles. Again, alluding back to Ray Dalio's principles. You have debt cycles, long-term, short-term, and this stuff impacts what we do every day. But you know what? Just going to grind it out here. Just going to build one house at a time, doing my part, trying to make sure that we get some more housing supply, trying to do my part to this community and give information back to everybody, make sure that we can talk about how we're going to build our economy and our, get through inflation and help create jobs. I feel good about this project. We found some construction workers and they're going to be working, putting food on the table for their families. And that food they bought from someone else. It might be a vendor, there might be a farmer, there might be a local small business, and that puts food on their table. And that velocity of money and that exchange of transactions that maybe starts right here is a big deal. And remember, these homes that we put people in, this is a forced savings plan. It gives you equity. It gives you a hard asset. So it's all part of the cycle. Housing is super, super foundational for our economy, for our communities. So please just remember, what we do matters. What we do every day matters. Have a great weekend. There's some data coming out next week, but again, the Fed spoke. That certainty brought to the markets. Look what it did to the stock market. Tech stocks are rallying because now, growth stocks like that are seeing the fact that they know how much the Fed is going to do on their actions. And so people can kind of calculate how much the dollar is going to be worth and, how much money will be in the system. That's good news. That is certainty. So every data point matters. It helps people feel good about making commitments with their own money, their life choices, and what they want to do. I hope this video brought value to you. Have a great weekend. Happy St. Patrick's Day. Erin go bra, smate.
You've been listening to KPTalks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KPTalks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KPTalks Dollars and Cents on all of our social channels.